Well, hi everyone, Shaun Humphries here with Assante Capital Management and the Humphries Wealth Group. Well, this particular presentation is part of a series of videos focused specifically on investment planning. This particular video is Investment Planning Philosophy and Process, which is the introductory video. And we're going to talk a lot about why many people are not achieving the success that they would like to achieve with their portfolios, some of the natural challenges that are out there for all of us as we try to invest. So for many people, the investment process has been unsatisfying, and we believe that has a lot to do with the fact that many people don't have a specific process that has been flowed out of successful principles that pension funds, foundations, and institutional money managers have used for years to provide a certain amount of predictability around the medium to long-term return expectations and performance on accounts. There'll be a number of videos following up to this video that unpack various aspects of investing. This is one of the longer videos because it really talks in a lot of detail around the challenges that we face as investors. And I think it's an important discussion because it really sets the context for all the future videos that we've put together. So it's our hope that you find this introductory video helpful. So let's begin the discussion by talking about why is this important topic. Of course it's important. You know, when you look at your portfolio, you have aspirational goals attached to it, maybe income security goals, maybe legacy goals. And so the things that you do with your portfolio and your financial assets can have a really big impact on our lives in many different areas. The second thing is we work hard for our money. We sacrifice, we set aside money, we invest money, and so there's a certain amount of emotional charge attached to the capital that we save personally. We want to make sure that that money is invested in and growing as effectively as possible. And then, of course, we live in a world where, again, having financial assets just creates opportunity, flexibility, and buffer to weather various storms that come into our life. And so money's not everything, but it's an important component to our lives. Now, behind the whole discussion around investment planning, what we found, because we've worked with clients for over 30 years, particularly in the retirement income planning area, where there's probably three main risks that many people are concerned about. So one of the first risks is inflation risk. So we want to be investing in such a way that we cope effectively with the long-term erosion of purchasing power because of inflation. So that's an important one. Secondly, we want to deal with the longevity risk. In other words, we don't want to have more life than income. So we need to get competitive returns to last our lifetime. And of course, people are living longer, they're healthier, their expectations around what they're going to do through the retirement years have changed, and those costs have been increasing over time. And so longevity risk is an important area. And then, of course, market risk. Market risk is ever present. Now, the reality is, there's way more time when the markets are going up than when the markets are going down. But we naturally will focus on those downturns because, again, the emotionally charged nature of our investments tends to have us focus in that area. And so when we construct portfolios, we're always mindful of these three risks. How do we deal with inflation risk? How do we deal with longevity risk? How do we deal with market volatility or market risk? So let's talk about some of the main challenges that we face as investors. Now, the first challenge, one of the biggest, is the fact that interest rates have changed so dramatically over the last number of decades. What this chart looks at is, how much capital would we need to have in a portfolio to generate $25,000 of investment income or interest income if we were buying 5-year GICs or guaranteed investment certificates? Well, you can see back in 1981-82, interest rates were at an all-time high going into 1982. 5-year GICs were paying, let's say, 13% a year. And if we looked at the amount of capital that we needed to generate that $25,000 a year of interest income, it was under $200,000 of capital. So the blue here is the required capital amount, and the green is interest rates. And so with the extraordinarily high interest rates, it didn't take as much capital to generate that income. Over time, interest rates fell, and so that by 2014, we're seeing some of the lowest interest rates we'd seen in decades. And even though we're not in 2014 today, at the time of this recording, it was 2018, interest rates are still very low. If we look at 2014, to generate $25,000 of interest income, we needed about $1.2 million of capital. That's the challenge for investors. So back in the 80s, pension funds, foundations, individual investors could just buy GICs, bonds, corporate bonds, government bonds, and reach most of the long-term goal. In fact, the huge win for many investors, if they locked in rates back here in the high teens, and then rates fell, but if they locked in rates and inflation went down, that's a great long-term win for investors. Today we're fighting this headwind of very low interest rates, and it's forced people to invest money in investments that maybe normally they would not have felt comfortable with. So one of the challenges today for investors, and particularly for retirees, is the interest income on the most conservative investments just are not generating sufficient return to help people accomplish their goals and objectives. And so now people are venturing and have been venturing into other alternative investments. Those investments aren't wrong, but people need to be educated and informed about how to deal with those investments appropriately in their portfolios. This is another chart that looks at interest rates. We're looking at the Canadian inflation rate tracked by the Bank of Canada. And you can see from 2013, 14, 15, 16, out through to 18, the inflation rate on average is around 2%, give or take. So that's been the inflation rate in the more immediate past. So the way we look at investments, and this is the challenge, is first of all, let's say that over the last number of years I could get a 5-year GIC or a 4-year GIC earning 2.5%. Rates are a little higher now, but not a lot higher. And if we look at that same time period, inflation's been around 2%, so I get 2.5% on my GIC, but inflation every year is going up, and that's 2%. And so my net of inflation return is 0.5%. So when I factor in the purchasing power of my money, I'm only making 0.5% per year. But of course, in a lot of capital that we're investing, and there's exceptions, tax-free savings account, currently if you sell your principal residence, that's a tax-free gain if there's been gain on the property. But in investment assets, often there's taxation, so taxation on non-registered investments, but there could be taxation even on your RSP, RIF accounts, although you may not be paying tax on all the portfolio all at once. It's a slow bleed out over time. The reality is for every dollar you have in that portfolio, there is a tax cost attached to it. So if we look at tax, let's say an average tax rate around 35%, marginal tax rate, the tax on that 2.5% would be 0.88%. And so when you look at the net of tax inflation rate, we're looking at minus 0.38% per year. So we got 2.5% was the gross return, net off for tax, net off for inflation, we're getting minus 0.38%. And that's called going broke safely. Now, that doesn't mean that you shouldn't have government bonds, GICs in your portfolio. In fact, those could be ideal investments for that part of your portfolio that needs to deliver to you income or liquidity over the next 3 to 5 years. But for that part of the portfolio that's generating returns for you going up 5+ years, clearly we can't deal with a situation long-term effectively, getting negative returns every year when we adjust for taxes and inflation. And that's one of the main reasons that investors begin to diversify portfolios and look at other alternative investments that provide better long-term performance to help them cope with tax and inflation. Now, the other challenge that takes place for all of us when it comes to investing is the fact that we're getting information from all kinds of sources, whether it's advertising, our neighbors, our friends. They always have great investment stories, right? The home runs that they experience on their portfolio, but you never really get the full picture. And so all this information is coming at us, of course, of late. The internet has been a very big source of information. The media, TV, of course, what the media tries to do is to get our attention. They do that by sensationalizing or really emphasizing that part of the story that's really negative, because that gets our attention, that gets our clicks. And so it can be very confusing. We have all these competing sources of information, but a lot of it's not built around process. A lot of it's not really built around the facts of a situation or which principles are really the high probability principles we should be using in our portfolios. It's not often I hear a manager of a foundation or a pension plan being interviewed on portfolios and markets. It's pundits that have a perspective, but they often don't have a full perspective. So our brain has a huge impact on our ability to be successful when it comes to investing. And of course, all this information that's coming at us, geopolitical events, news events, information on the internet, our friends, family, neighbors, all of that creates a certain amount of reduced cognition because it creates anxiety. So low stress, sort of mild stress levels, a lot of people are in chronic stress. So we have this oscillation we should be experiencing in life between the stress response and relaxation response. But a lot of people are sort of in this low-grade stress and anxiety level. And what that does is it creates a little bit of reduced cognitive access. In other words, as we go through stress, our cognition becomes a little more concentrated. We are not as creative. We don't look at the grand sweep of information as easily. And sometimes we become reactive when it comes to making decisions in life generally, but particularly when it comes to portfolios. So what we tend to see with people during times of market calamity, economic calamity, geopolitical events, is people make knee-jerk decisions or kind of reach for things they think might solve the problem with a portfolio, when in fact their portfolio might be properly structured and aligned with their goals and objectives, but the anxiety of the situation creates this knee-jerk kind of response, which actually probably more often than not hurts their performance, doesn't help it. The other thing is we have cognitive and emotional bias that filters into our decisions, and this is not exhaustive, but these are ones that we would recognize. Of course, crowd following, we all succumb to this. When we see the crowd moving in a certain direction, that certainly can be the case when it comes to capital markets. As they're moving higher, we want to participate in that, and so that crowd following is a natural driver in our responses. Sometimes we can be overconfident in our positions, and that can lead to bad decision making when it comes to our portfolios. Family of origin, obviously our background in terms of the families we grew up in, our personal circumstances influence our approach to life generally, but also influences our approach to investing, and we're not always aware of those influences. So it's worth actually taking time to unpack how our backgrounds, our histories, our families have impacted our approach to investing, because if those things are unconscious and we're not aware of them, we could end up making some bad decisions because of those unconscious drivers. We've got employer or industry. I remember working in downtown where I work, and Nortel, which is a tech company manufacturing fiber optics cables and products, very successful company. The stock went ballistic, and I remember going up and down the elevator with people who worked for Nortel, thinking that stock could do no wrong. And a good part of their net worth was, in that stock. And of course, the end of the story was the stock basically went almost down to zero. For all intents and purposes, the company went bankrupt, and those people lost a good part of their life savings. And so we need to be a little bit objective sometimes. Yes, you can be committed to your company, the stock options, the different things you have in the portfolio that might be tied to your industry or company, but you want to be realistic. And as we get older, particularly, it's important to begin diversifying away sort of a more niche kind of focus strategy and look at other alternatives that might be appropriate for the portfolio. Now, we also weigh gain and loss very differently, and that influences decisions. So psychologists will tell us that, for every unit of loss we experience, we need anywhere from 2 to 3 units of gain to counteract that loss experience. It doesn't make, logical sense that is the case, but certainly from an emotional, psychological standpoint, that's how we respond. And so we'll tend to overreact to negative news, and we'll somewhat undervalue or underreact to good news. This chart is the cycle of investing, and again, this is just an objective way of talking about the roller coaster that we ride sometimes when it comes to investing in capital markets. And no one's immune from this. We all go through situations where we're investing, the market's going, doing well, we feel a little bit euphoric, we're adding more money to the portfolio, everything's good, and then we see the markets begin to turn. Now we're full of anxiety or denial or fear, and then we get into negative territory, and that's where you can see panic, capitulation, selling out. We're despondent, we're depressed sometimes, and then we see ourselves coming out of that trough again because things are beginning to improve. This is the natural emotional piece of investing, and we need to tame this tiger before we invest money or while we're investing money. This is just the reality of capital markets. We live in a very complex world. It doesn't matter what strategy you pursue. No strategy is going to protect you from the uncertainty in the short term that is the world, whether it's politics, economies, surprise events. And so when we invest money, we need to be aware there's going to be volatility. Now, again, the reason I'm talking to you about this is that if we could reach our goals going broke safely every year, you don't have to worry about these kinds of discussion points. But the minute we start putting money into stocks or stock mutual funds or balanced accounts that are subject to market fluctuation, we need to become conversant with these ideas. We need to be aware of them. So again, it's not if the market's going to go through fluctuations, it's just when. And we need to have the right mental and psychological mindset to get through it successfully. Now, the other piece that we talk to clients about is the importance of diversification. And one of the reasons for that is, again, we have a natural inclination to take last year's winners and use those investments as a proxy as to where we should invest now and ignore last year's losers. In fact, we want to sell off last year's losers and buy something different. But when it comes to successful investing in capital markets, not always, but generally speaking, when you've got quality investments that are at a loss position, that should be your signal to buy. And if you've got quality investments that are at a gain position that did pretty well, that might be a time when you need to harvest profits, take some profits from the portfolio. What this chart does, it takes a look at the returns of these major investment categories. You've got U.S. equities, U.S. small cap stocks, Canadian bonds, emerging market equities, international stocks, Canadian small cap stocks. And what you see here is, you can see in 2000, Canadian bonds were the best performing investment. Actually, they had a pretty good run this 3-year period. And then you can see by the 4th and 5th year, they're one of the worst performing areas to invest. And so there's a certain randomness here of return between all the different investment categories. We call this the return quilt. And so what it speaks to is it's a little bit dangerous to begin focused on just one area or a collection of areas just because they did well last year. What we tend to recommend to clients is, again, we live in a very complex world. We might have hunches or ideas from the analysts and portfolio managers about what areas are likely to do the best. We'll tend to tilt portfolios in the direction of the client's long-term to medium-term return goals. And we may tilt in the direction of growth investments or stock investments and underweight bonds. Or if a client's more short-term and capital preservation oriented, we might go to more of a mix of bonds and GICs. But what this chart is designed to underscore is it's not useful to be focusing in on last year's returns as a proxy for this year's investment decisions. A better approach is to diversify. Again, you may tilt your portfolio in certain directions, but you don't want to put your whole focus on just the performance piece because it can be quite variable, as this chart underscores. This is a great chart that talks about market timing. So this is another challenge for us, and that is that we can stay away from the sting of a bear market or a bad market and just enjoy the run of a bull market or a good market, and that we can avoid the downturns. The problem with that strategy is it's a low probability strategy to try to employ. This chart looks at the period 2000-2010, looking at the TSX, S&P, the Canadian stock market from 2008 to 2017. And you can see that it incorporates part of 2008, which is one of the worst years that we've seen in decades in terms of capital markets. Now, if we'd stayed fully invested, just parked the money in the portfolio in 2008, didn't look at our statement again until 2017, at the end of 2017, we can see the return was 4.7% per year on a compound annualized basis. Not a very satisfying return, but still not bad given what happened in 2008. Now, if we happen to miss the top 10 days in the market, the return was minus 1.5%, or lack of return, compounded. And if we missed the top 20 days, our return was down to minus 5.3% per year on a compound annualized basis. So what this underscores is a fairly concentrated number of days over a 10-year period that drove most of the return. And this is why it's problematic. If you're in the market, and so the first thing we need to understand is that, do we need stocks or a stock portfolio or growth assets in our account to reach our long-term goals? Now, the minute you satisfy that question with the answer yes, I need a portion in the market, then the second question is it productive to try to move in the market when we think it's going to do well, move out of the market when we think it's going to do poorly, and try to execute on that strategy? And what this chart's going to underscore is that, no, it's not a productive strategy. If only 10 days basically accounted for the vast majority of the performance in the portfolio, what's the chance that you could miss those 10 best days by trying to go in and out of the market? And I would say that the chance is very high. And the reason for that is that when we pull money off the table, because we're concerned about market volatility, we're going to go to cash, that's the first decision. But the second decision is we have to move money back into the market. And how do you execute on the timing of that? And what we know is that once someone pulls money out of the market, goes to cash, it takes an awful lot of confirming information, positive information, for them to move money back into the market. What we also know is that markets tend to surprise in the upside, that concentrated number of days that drive most of the return are often situated at some of the worst parts of the market. In other words, the rallies in the market take place when people least expect it. There's no one sort of calling from the rooftops, now's the time to buy into the stock market. The market's going to rally today. Usually it's a surprise to people. And that's why most institutional money managers do not try to time this market issue, right? It's retail investors, as you'll see, that do that, but institutional investors tend to be far more disciplined. Now, it doesn't mean you don't fine-tune your portfolio and make adjustments along the way. I'm not saying that it's black or white, but generally speaking, once you commit to equities or growth assets in your portfolio, you don't want to be going back and forth. Because when you do that, there's a very high probability that you're going to blow up your performance. You're going to underperform because you're going to miss the days that are really driving the performance. And so one of the downsides of growth investing is it takes patience sometimes. It could take a number of quarters before you get some of the performance that you want. So you need to know that going into the portfolio. It's not a linear kind of just steady upward as we go. It's a fairly fluctuating return curve. Overall, we might be up, but through that short-term cycle, we might be down. So that's a helpful, I think, concept to be aware of. Now, this is how it breaks out in the real world. This was investment information from 1992 to 2011. It was compiled by the Investment Funds Institute of Canada. And what they looked at was, over that time period, they took all the available stock mutual funds for Canadian investors and said, cumulatively, what's their return? It was 8.2% compound annualized between 1992 and 2011. And then they looked at the unit holders that actually bought those same mutual funds, those stock mutual funds over that time period, and they calculated that their return was 3.5% per year. Massive difference between the actual fund managers that were offering equity funds and what the investors actually received in the portfolio. Why do you think that was the case? And if we go back to the previous chapter, this is why. They missed some of those key days that were driving the market, because when the market was doing poorly, they didn't want to add money back in because they were concerned. And when the market was doing really well, that's when they were buying at the latter stages, when there's a lot of confirming news that things looked like they were doing well, and all of a sudden the market then corrects a little bit, and then they panic and they sell out of the portfolios. So it's a really, really good sort of object lesson around the fallacy of trying to time the markets. Like I said, the big question is, do you need stocks or growth investments in your portfolio to reach your long-term goals? That's the first question. Number two, if you do, market timing is not productive. And we'll talk about some other strategies that are much more productive for managing risk as we go through this video series. This is just another chart that illustrates the point of underperformance by the average investor. And so the reason we put this video together was to make sure that you are not the average investor, that you're using the laws of probability in your favor. But what's interesting, between 1994 and 2013, JP Morgan did this study, and they found that real estate investment trusts did 10.3% per year over that time period, oil 10.2%, the U.S. stock market 9.2%, European international market 6.1% a year, gold 5.8% per year, bonds 5.7% per year, home real estate 3.1%, inflation 2.4%. The average investor did do 2.5%. So the average investor investing money in various investments moderately outperformed the inflation rate. That is not good enough, but that's again why many people have had frustrating experiences investing. And again, we'll talk about the process you need to have in place so you're not getting the average that investors get, that you're getting more of the market returns that are available. So over the next several videos, we're going to talk about increasing the probability of success. with your portfolio. So it's my hope that you found this introductory video helpful. It's more just to set up this particular discussion, but I think it's worth noting that there are psychological reasons, emotional reasons, there are dynamics at work that keep us from achieving our goals financially, and the more we're aware of them, the greater the chance then that we can make the right decisions going forward. It's all about education, right? So again, hope you enjoyed the presentation. You may know people who could get value from a presentation like this and the video series we're putting together. Make sure you forward this video to them. They can take a look at it. Here's our contact information if you'd like to start a conversation. If you've never thought about having an investment coach or retirement coach or wealth planning coach, reach out to us. Ask Humphries at Assante.com. Contact phone number is 204-977-8049. And of course the website, ShaunHumphries.com. Wishing you all the best with your portfolio and your wealth planning. You take care.